this week's U.S. inflation and labor data is set to guide Fed outlook, while SA awaits key local releases later this month. Naeem Aslam, Chief Investment Officer from Zaye Capital Markets, brought us a look into the economic week ahead. And I started off by asking him to recap on the labor data that was out last week.
The data that we received last week, there were a number of elements that we need to pay attention to. And then here are the two important factors that we need to pay, that we are paying attention. Number one is how bad that data is. It only matters up to a point where how Donald Trump sees it. Because if he continues to believe that the data is not being accurate, he will change the labor statistic head once again. We have already seen that happening, so we could see that again happening. Number two is 2025 year was about what? It was about the actual deployment of AI, right? So what AI has done, it has replaced a large number of workforce with technology. So that has also been reflected into this particular number. And I'll give you one additional point, which is the third one, and that is the delay in the data, the noise that has been created in the data. So we are not sure what exactly the numbers are. This is why we are now a little bit more focused in terms of unemployment claims, because they are slightly bit more timely, they are less delayed in terms of the overall picture, because the overall picture is just full of noise and we don't really have that much of a clarity that we used to have. So maybe in the next month, when we will have the US non-farm payroll data, we will have a lot more better understanding which way the labor market is ticking and what the Federal Reserve's next reaction is going to be. Now, having said the Federal Reserve's next reaction, which I'm sure you will have plenty of questions about, that depends on a large number of factors. But one thing is for sure, the path of least resistance for these interest rates is skewed to the downside.
And we'll get into the distortion of the prints that we've been seeing on the back of the U.S. government shutdown. I want to get into the U.S. Inflation print that's due this week. We do know that the Fed's main mandate is twofold: to, of course, ensure that the labor market remains strong, but to also ensure that price stability remains, right? What are your expectations for inflation this week? There are, concerns around those tariffs coming through in the print that's coming out this week.
Yeah, okay, that is a big question, and we have to break it down into a few different points. Number one, of course, on the headline front, 2.7% is expected, which is very much the same as of last year on year-on-year basis, or even if you look at month-on-month basis, you look at a 0.3%. Now, the other point that you've mentioned, which is a very interesting about tariffs themselves are very much sitting on a tipping point, because why I am saying that one? The reason that I'm saying that one is because, we have this major ruling which could unturn all of these tariff drama that we have seen. Now, let's assume that the court's decision comes in favor of Donald Trump, i.e. tariffs remains where they are. Then you look at inflation situation, you say, okay, obviously with the tariff equations coming in, the inflation is going to take to the upside. That is going to create pressure for the Federal Reserve. Again, that is a very complex question to answer, which I'd love to do that. But theoretically speaking, that is going to increase inflation. But here is a caveat to that one. And the caveat is very much on the fact that what happened last week and what could happen in the coming weeks as well. What do I mean by that? I mean like the invasion of US in Venezuela, acquiring the largest supply in terms of oil. Why oil is very important? Because it underpins inflation in terms of energy. If energy cost goes down, on the other side you have this tariffs equation, which is going to push inflation to the upside. So they both kind of head on with each other. And we believe that energy equation is going to be more important. But the story doesn't stop over here.
Yeah.
Because The reason for that is because the next potential element where traders are focused on is what is going to happen with Iran. Because it seems like the regime change is going to take place. It seems like that the US is going to take action in terms of its military action over there. So that means that on one side, US will control the Venezuela oil. On the other side, they will also have a lot of leeway to say in terms of how much oil production we could see in the coming months. Because remember, right now, everything was under sanction to a larger extent, how much Iranian oil can hit the market. So again, that equation that we talked about earlier with respect to inflation, and that is driven by energy, which is the fuel, consider it like a fuel for your car, right? That's going to impact that. So yes, tariffs may adversely impact inflation, but the impact of the overall energy prices from a macro lens and from a long-term lens, that is going to have a positive impact on inflation. What is the positive impact? The positive impact is that inflation should take lower regardless of where the tariffs are going to be going.
Yeah, I mean, so much at play, and I loved how you highlighted how the dynamics playing out in the oil market will then trickle down and influence the inflation picture as well. So that playing out on a macro level. Internally, though, we did touch on the distortion of some of the data we are getting out. And I'm wondering then how the Fed then reads these prints with so much at play, so much risks at play as well.
Yeah, like when it comes to Fed, we have two versions of Fed. The outgoing version of Fed,
yes,
which is Jerome Powell, and then the inward coming version of Fed, which is going to be the new head of Federal Reserve Chairman. He is very much in line with what Donald Trump wants him to do, right? And then he has mentioned the trajectory of interest rates are going to be going to the downside. So from where we sit, from the investment perspective, we are not concerned that interest rates will remain stagnant or there would be a very gradual move to the downside in 2026. We believe that the momentum is actually going to pick up in terms of interest rate basis cut, regardless of where the federal fund rate is sitting now. I think that it is only a matter of a time when we will see a major shift in terms of an interest rate cut. So what would that do to the entire equation? Only one thing, and that is market loves cheap money.
Yeah.
When cheap money comes in, it's going to go high. If you are an American living in America, and then you're going to see your prices for gas going down, that is the only thing that you're going to be concerned about. You're going to say, okay, my cost for living has come down, money has become more cheaper, so let me go and invest. And when investment comes in, obviously stock market rose.
All right, let's leave it there then, Naeem. Thank you so much for your time and sharing your insights with us this evening.
Thank you for having me.
Now, that was Naeem Aslam, Chief Investment Officer at Zaye Capital Markets.